Your credit score is the most important determining factor in deciding which loan programs you qualify for, which interest rates you'll be receiving. And as a mortgage lender that has been doing this for a decade now, I look at people's credit every day and I see that people oftentimes are focusing on the wrong things. In this video, I'm going to break down the 5 factors that determine your credit score so that you have a better understanding of credit score overall and so that you can focus on the right things. By utilizing these tips to work on building your credit over time, this will help you save time, stress, and certainly thousands of dollars over the long term on your home purchase. And with that, let's get into it. If I haven't met you yet, my name is Connor Webb. I'm a mortgage loan originator licensed in Washington, Oregon, California, Idaho, and Arizona. You can visit lenderconnorwebb.com to reach out and get in touch if you have any needs. And whether this is your first home purchase or your 10th home purchase, these tips and tricks will still apply. So before we get into the factors, what exactly is a credit score? Well, a credit score is a 3-digit number that lenders use to predict your credit worthiness or your likelihood that you're going to be repaying the loan that you're going to be receiving. Credit scores typically fall between a 300 and 850 score, with a good score helping you get potentially a better loan with lower interest rates, while a lower score might make it difficult to qualify for credit in general, and lower credit scores in general will result in higher interest rates. In general, we see that every 20-point increase in your credit score is going to offer some type of benefit when looking at interest rate pricing. And the 5 factors that have an impact on your credit score, which are weighted differently, are your payment history, the amounts owed, your length of credit history, your new credit, and your overall credit mix. And with that being said, starting with the largest overall factor, this is your payment history, which makes up 35% of your overall credit picture. As you might imagine, your payment history is the largest factor in determining your credit score. If a lender is going to be lending you a certain amount of money, they want to see that you will pay what you owe on time, every time. So various factors that are included in your payment history are going to be on time versus late payments. Whether or not you have 30, 60, or 90-day lates, the larger of a time period that you're not making your payments is going to have a larger impact on your credit score. If you have any collections accounts in your history, if you have any charge-offs, if you have any bankruptcies, foreclosures, or repossessions in your history, and certainly how recent and severe these events are will have an impact on your credit score. If you have, a 60-day late, but that was 3 years ago, eventually your credit score will continue to increase over time if you make your payments on time after that event had happened. But your payment history is a big deal. One 30-day late can drop your credit score 60 to 100 points. If there is one thing you take away from this video, it is this: make at least your minimum payment on time every month for the best results. The second you stop making your minimum payment and it becomes a 30-day late, a 60-day late, a 90-day late, that is going to tank your credit score in the short term. So my advice from a mortgage lender is, if you're going to get a loan of any kind, if you're going to open up a debt account of any time, make your payments on time. Don't overcharge your accounts to an amount to where you can't even make the minimum payment. That leads us to the second largest factor that determines your credit score, which is your credit utilization. This makes up 30% of your overall credit picture. Credit utilization can also be referred to as amounts owed, and essentially this is how much of your credit limits are you currently using. This is measured as your total balances divided by your total limits. Now, in general, a healthy credit utilization is somewhere below 30%, but the best scores show under 10% of overall utilization. So for example, if you have a current balance on a credit card of $1,000 and you have a total credit limit of $10,000, this equals a 10% utilization, and anything below that amount would be ideal. And when looking at this scenario, in order to lower this utilization even further, there's 2 ways that you can do that. One, of course, would be to pay down your current balance, or the other way would be to increase your overall total limit. And this brings me into my next big tip on how you can increase your credit score in the short term. And this is to request a credit limit increase annually to reduce your overall utilization, even without paying down your accounts. I personally do this on an annual basis, to where I reach out to all of the credit cards that I have opened up and I request a credit limit increase. Even if I don't use that card at all, I'm going to ask for a overall increase, because when talking about credit utilization, it takes into account individual accounts, but then also your utilization as a whole. So on this above scenario, as I mentioned, if you wanted to reduce your utilization below the 10% number, you could either pay down that $1,000 balance, or you could increase the overall limit above $10,000. Of course, I would note that if you are not comfortable with increasing your balance because you think that will push you to spend more money, do not do that. But if you feel like you are financially responsible and that increasing a limit won't push you to spend more, then this would be a safe bet to increase your credit score in the short term. And it's worth noting also that utilization only applies to revolving credits, so credit cards and HELOCs if they have a running balance. This does not apply to mortgages, to auto loans, or to student loans that are an installment loan instead of a revolving account. Now, moving to the third most impactful factor that determines your credit score, which is your overall length of credit history. This has about a 15% weight on your credit score. Your average age of your accounts includes how long your credit accounts have been open in general, the age of your oldest account, the age of your newest account, and how long since each account has been used. In general, having your accounts open for longer is better for your credit score as it shows the lender that you can maintain an account. Of course, you have to get started somewhere. If you're just now opening your first credit card to establish credit, then do so. That's great. But of course, having older accounts will help in the long term. For example, if you have just one account that is 1 year old, then your average length of history is just 1 year. But let's say you also have an account that has been open for 10 years. This will mean that your average length of history is 5 years in total. So if you were to open up a new account, it could have a negative impact in the short term, but over time, it will continue to increase your average length of history. The tip I have on this factor is to not close out your old cards unless absolutely necessary. This is something that I see people do oftentimes because they think it will help, but really it does not help. Let's say you don't use that credit card very often that you have open for 10 years and you're like, hey, I'm not using it. I might as well close out that account. Well, if you delete the 10-year account, then that changes your average length of history from that 5-year mark down to just 1 year, which has a negative impact on your credit score. So the best advice I could give here is you could pay down your balances to a zero balance if you choose to do so, but do not close out your old accounts because it very well will have a negative impact on your credit score. This brings us to one of the low impact factors of your credit score, which is new credit and hard inquiries. This makes up about 10% of your overall credit picture. When you apply for new credit, a hard inquiry typically drops your score 3 to 7 points temporarily. I generally advise my clients to not worry about the potential drop of a credit score from a hard inquiry, as again, it does fall off over time. And until we have an actual credit report, I can't give you really any useful advice because I don't know your true credit picture. And after all, once we have a credit report, I can actually run a credit simulator. If you're close to that next tier of credit score to help your interest rate pricing, then I can actually tell you exactly what needs to happen in the short term so that we can run a rapid rescore and boost your credit to give you a better interest rate. If we don't pull credit, I can't do that. Now, if you start to hammer hard inquiries like crazy, then that could have a negative impact. But again, it's a 10% weight on your overall picture. This also takes into account how many new accounts were opened recently, and essentially how aggressive are you seeking credit. There is a rate shopping exception, however. So for example, if you're getting multiple mortgage, auto, or student loan inquiries within the last 14 to 45 days, they will count as one inquiry. So you could get your credit pulled by multiple mortgage lenders, multiple car dealerships or lenders, and that won't have any additional impact if you're within that window. And like I mentioned, your credit really only matters when you're looking to apply for a loan, and inquiries fall off over time. So don't let the fear of an inquiry or the potential short-term negative impact that can have on your credit score hinder you from applying for a loan that you're looking to get. You don't want to go completely crazy with inquiries, but you don't want to let that hold you back from applying. The last factor that determines your credit score, again, this is tied with the new credit. For the lowest impact on your credit, this is your credit mix, which is also 10% of your overall weight of the credit score. Essentially, lenders want to see that you can manage different types of credit. For example, a mortgage, a car loan, a student loan, a credit card. If you have 4 different accounts open in 4 different categories, that's going to be an overall benefit to your credit score. And like this says here, a mix helps, but it's not a make or break unless your credit file is thin and you don't have a ton of history. So a quick recap, your payment history is going to make up 35% of your overall credit picture. Your amounts owed is going to be 30% of your overall credit history. Your length of credit history is 15%. The new credit is 10%. And then also your credit mix is going to be 10% as well. So thank you for watching. If you have any questions on your credit score in specific with how I might advise you to boost your credit score in the short or the long term, feel free to reach out. If you're thinking of getting pre-approved for a mortgage, whether it's a purchase or a refinance here in the next year, Washington, Oregon, California, Idaho, or Arizona, make sure to reach out. Here's my contact information, or you can visit leonardconoweb.com to submit your information and I can reach out and we can get in touch. For more mortgage and real estate content like this, make sure to subscribe to this YouTube channel. Let me know if you have any questions or opinions in the comments below, and I'll see you in the next one.